Hello and welcome to this week's special presentation. My name is Jim Penna, Manager of Retirement Services here at VectorVest, and I'm very happy to be hosting this week's topic, which is titled, How to Keep Making Money. There are a lot of retirement advisors and newsletters out there that look to model how far your retirement nest egg will take you into the future. And they address questions like how long will I live, or how much money will I need for health care, and so on. One headline for an advisory I just read this morning is how far will $1 million go in my retirement? And I guess it's okay to have the numbers written down and have a starting point, but the fact is we can't know the answers to those questions. So most folks will do their best to prepare as they approach retirement and hope for the best. Well, here at VectorVest, we believe you can do more than just hope. I've shared with our subscribers for quite a while now my conversations with Dr. DeLito about the questions and concerns that are brought to us here in the Retirement Services Department. The underlying theme of these questions is always, how do I keep from running out of money in retirement? And the answer, we determined, is what we call the ultimate retirement solution. And that solution is to keep making money. Because of the uncertainty that lies ahead in retirement, we can't know all the answers, but continuing to generate a steady income along the way will help resolve a lot of issues. Let me start by defining what we believe a secure retirement is. And we believe it's one in which you have enough income to live the life that you desire, where work is optional and retirement is affordable. And we achieve that by adhering to the three key principles that are attached to just keep making more money. The first is capital appreciation, simply buying good quality, undervalued stocks that are rising in price in a rising market. Next is income, the ability to generate a steady income flow using dividends and the sale of covered calls in our retirement portfolio. And then finally, every bit as important as continuing to keep making money in your portfolio, it is the preservation of that capital that is also extremely important. And so we talk about portfolio insurance and insuring individual positions in your portfolio at the very strategic times that where we need to take control. Let me start by going into the program and we'll take a look at each of these key principles. I'm going to start with capital appreciation. And to do that, I'm simply going to go into the Unisearch tool and I'm going to take us to a search called Long-Term Winners RS Descending as our example here. And the reason I choose this is because it has very basic parameters, but the sort is the key here. It simply takes relative safety descending as the sort. And any stock that trades greater than $1 and has an average volume of at least 100,000 shares a day and is not a penny stock or a bulletin board stock comes to the list. So a very basic search, but the power of the sort is where we want to start with. So just to give an example of the high relative safety or RS stocks, remember, relative safety is an indication of the stock's consistent and predictable financial performance. And so we look at stocks that come up in the search like this and we see relative safety numbers that are excellent in the VectorVest program. And as I've often said about relative safety in the VectorVest program, when the RS is at those levels, the numbers that we care about usually fall into place. So relative value, which is the capital appreciation potential. Comfort index, which is the price growth persistence, all very strong here. Earnings growth rate numbers are strong. And for the companies that do pay a dividend, that dividend safety is also very strong on that 0 to 99 scale. So that's the power and the beauty of relative safety in the program. So with a list of stocks with high RS as we find in long-term winners, if I go ahead and graph the top 10, what I have set up here is the price of the underlying stock on the upper portion of the graph. Down below we have the earnings per share in the VectorVest program, and I'm looking at a 5-year look back to get a good history of the underlying stock here. And what we'll see is a very familiar pattern. The price of the stock rising from that lower left to upper right price pattern, and when we look at earnings per share, we also see earnings per share doing the same thing. And as I've stated many times, it's not by coincidence that as the earnings per share continue to rise, so too does the value of the underlying stock. And we can see a very familiar pattern as I just scroll through these top 10 stocks. As earnings grow, so too does the price of the stock. As I continue to scroll through, you'll see the pattern and the correlation between strong earnings per share, steady growth in earnings, and the movement of the underlying stock price. So these are just the top 10 from long-term winners when we sort them by relative safety. Go ahead and close the graphs. And what I'd like to share now is a portfolio. If I go to our Portfolios tab, I have a portfolio here that was created. This was actually created as one of our model portfolios in our group coaching course way back in December of 2013, and we've been tracking this portfolio since. And it uses the worry-free winners search, which is also sorted by relative safety. And as you see, the relative safety numbers on the stocks here are excellent as well. And so this is roughly a 6-year look back, again, as it started in January of 2013. And we're up over 95% in this portfolio over that time frame. And what I would point out here is that does not even include the dividend payouts that we would have received over that roughly 6-year span. So as I scroll over on our spreadsheet here, you'll see all of these stocks within the worry-free winners search do pay a dividend. They have a very safe dividend. The yields range anywhere from just below 1% to as high as 2.25%. And so when we add the dividends in here, we are up well over 100% over our 6 years of tracking this longer term portfolio. So when we fill a portfolio with these type of high quality stocks, these are the kind of returns we can look for in the portion of our retirement account where we're looking for capital appreciation. Next, I'm going to go back into Unisearch and I'm going to address the income side and the second key principle of how to keep getting paid in retirement. I'm going to use the blue chip dividend payer search as an example. This is a search where we've built portfolios on using very general parameters here. We're looking for stocks that are only in the Dow Industrials, Transports, or Utilities, or in the S&P 500. Any stock that comes up on the search must have at least a 3% yield. We're taking only stocks from the watch lists that are what we call the DRIP or Dividend Reinvestment Plan watch lists of 10 to 24 years, or the DRIP 25 plus. All that means is that any stock that appears on the search has not only paid but has grown their dividend for at least the past 10 years or longer, some of them 70, 80, 90 years or more. And then finally, the dividend safety has to be greater than or equal to 50. Again, that's on a 0 to 99 scale. So if I go ahead and run the search, these are the type of stocks we're going to see. Now, the relative safety numbers are not as strong as our growth portfolio, mostly because, as you'll see, these are very recognizable names. These are more mature companies with a strong free cash flow that have earnings growth rate and dividend growth rate numbers that are very strong. In fact, the sort is growth rate times dividend growth rate. We bring those stocks to the top of the list. And as I noted, the dividend yield has to be at least 3% just to make the list. And you can see the type of dividends that are coming in. Let's go back into the Portfolios tab and I'll share results here as well on the URS Blue Chip Dividend Payers search. Again, this one began in our group coaching and we use this as our model here way back in 2013. And you can see the value of the portfolio. What we get from this, not only are the dividends paid, but we have a very strong capital appreciation run here as well on these dividend stocks. And while we do like the capital appreciation, remember the objective here are the dividend payouts for that steady income. So the value of the blue chip dividend portfolios will fluctuate. Sometimes it will stay flat. 2015 was actually a down year in the market. The S&P 500 was down. You'll see blue chip dividend payers held its own here and paid some nice dividends throughout the course of that year as well. And then we were able to reap some capital appreciation also. Now, what we don't see here, just like in the worry-free winners portfolio, are the dividends that have been paid out. And so what we would do here is add just over $28,000 as I have calculated the dividends paid on any and all positions that have been held in this portfolio over that 6-year time frame. And that number comes out to over $28,000. So you're really looking at over $108,000 in total value of the portfolio, and that doesn't include the compounding of those dividends. So if you were to reinvest those dividends, this number would be even stronger. Now, you don't need to reinvest them, but if you do, the power of compounding on your dividend payouts is amazing over time. Now, finally, I want to address our third key principle, and as I noted, preservation of capital, the ability to mitigate those violent drawdowns in your portfolio is extremely important as we manage our retirement nest egg. For example, if I go back to the worry-free winners search, and if I take a closer look at the equity curve, we'll see the sharp drawdown we faced at the end of 2018. From October 4th right up to Christmas Eve of 2018, the market had a very sharp, violent sell-off. There was a large drawdown in a lot of folks' retirement accounts. So what I want to do is address that preservation of capital and talk about some of the defensive measures that we can take. And whether it's the overall market or if it's an individual stock, we can be strategic in our defensive techniques and preserve that capital. So let's go ahead and show some examples of that final key principle. I've used this example before. It's a very good illustration of the power of two very basic option trades. We believe it's imperative that you understand and are able to implement these two basic option trades if you are managing your own retirement nest egg, and that is the covered call and the protective put. The example I'm going to show you right here is called a collar trade, and the reason I choose the collar trade is so that I can show you an example of both the covered call and the protective put. Now in this example we're looking at Ross Stores, and I've set up a scenario here for us. Back on June the 6th of 2018, we purchased 100 shares of Ross Stores at $84.06. This was part of that worry-free portfolio I showed from our retirement coaching group. So this is an actual model portfolio that we were managing. On November the 12th, Ross Stores traded as high as 103.77, which leaves us with a 23% gain on that position. That's an unrealized gain of 23%. So we bought the stock when the market was rising and it showed up on our list. It did exactly what we wanted it to do and reached a peak of 103.77 or 23% gain. The scenario then takes us to the next step, which tells us that Ross Stores, because we do our due diligence on all of our positions, we know that earnings are to be announced on November the 20th before the bell, which means it's time to act. There are several things you can do here. You can buy a protective put, which I'll talk about in a moment. You can sell a covered call to lower your cost basis and build in a cushion in case earnings don't go as expected. But here we're going to set the collar trade up to show both of those as one trade. So again, our scenario has us buying the stock back on the 6th of June. Here are the steps to setting up the collar trade. First, with Ross Stores trading at 101.77 just about a week before earnings, that's indicated here, we would go out and sell one covered call. That covered call would be the December 105 strike, which is one strike out of the money from where the stock is trading. We would sell that call and we would have taken in $2.90 per share, or $290. That's the first step. We would also at the same time buy one December 100 strike put option at $3.55 per share. Remember, the put option, the owner of a put has the right to sell 100 shares of a stock, in this case Ross Stores, at a certain price by a certain date. So all we've done here is allowed us to have the right to sell Ross Stores at $100 sometime between November 20th and the expiration date in December. Why is that important? Because if the price of Ross Stores falls, the value of this put option will rise, thereby offsetting the loss in the underlying stock. That's why we call it it's simply an insurance policy on your position. We sell the covered call because we take in money for selling that call. And so here's what happened. We took in $2.90 for selling that covered call option. We then apply that to the $3.55 premium that we pay for our put option. So what it comes out to is a $3.55 put premium paid, or $355 for one contract, minus the $2.90 we received for selling the call. What that amounts to is 65 cents per share. That's $65 you paid to insure at that point what was over a $10,000 asset. So that's our setup. Let's see what happened. Ross Stores on 11/20 announced earnings before the bell, and the stock, well, it gapped down. It closed at 82.64 on 11/20/2018, trading even lower throughout the course of the day. That's a big move in that stock. So based on our strategic defense technique, what just happened? Let's take a look. This is just a screenshot from our options analyzer, and I use it just to illustrate again the anatomy of what just happened here. So we'll start here down at the bottom line. Had you done nothing, if you just held your Ross Stores throughout the earnings announcement without taking any action, you would have lost $142. On November the 20th, when the stock closed all the way down at 82.64, from your purchase price, you would have lost $142. Now, why is that important? Because remember, you bought it at 84.06, but it was trading at over $100 when we placed this insurance policy. So yeah, okay, I only lost $142, but really that stock was trading over $101, and so you lost really a lot more than that. However, because we took action, we were able to profit from the options that we sold, that call option. We were able to take in $285. Again, these numbers are at the close of trading on the day earnings were announced. So we would have kept $285, and that put option, that insurance policy that we bought, spiked all the way to $17.28 per share, meaning that we made just on one contract $1,373 for a total of $1,658. Now, when you add in that 65 cents per share we had to pay, that gave us a cost basis on our stock now of $84.71, or $8,471 on the entire position. Our overall gain then is $1,516. So let me be clear, our stock went from $101 to $82. We profited by $1,516. That's a gain of just under 18% from that adjusted cost basis. In other words, you would have slept a lot better the night before earnings were reported on your position. Now, what we can also do, aside from our individual stocks and protecting them with either collar trades or protected puts, we can also place an insurance policy on our overall portfolio. And the way we do that is by buying put options on the SPY. The SPY, or the Spiders, is the ETF that tracks the S&P 500 index. We have a very basic formula that we use to determine the number of contracts needed to help insure our portfolio. We simply take the value of the portfolio, we divide it by 100 times the put strike price per share. So here's an example. Currently, the SPY is trading roughly right around $288. So if you had a $100,000 portfolio, theoretically, you would divide that by 100 times 288. And in our example, that would mean you would need 4 put contracts to insure your $100,000 portfolio. Let's take a look and we'll plug in the numbers on this slide. So again, SPY is trading at 288. 288 times 100, which is one contract, is $28,800. So here's where the method comes from. Theoretically, if I owned one put option on the SPY and I owned the 288 strike, and the SPY, and it won't happen, I understand, but if the SPY were to go to zero, theoretically, I would have the right to sell 100 shares of SPY at $288 if that were the strike price that I purchased, which means my put contract would be worth $28,800. Now in this case, in the example I want to show, we had the 285 put strike. So we were just slightly out of the money with the SPY trading at 288. We bought an insurance policy, so we have a small deductible, a 3-point deductible, but we now have insurance on our portfolio. So using the 285 put strike times 100, in this case would come to $28,500. So if I wanted to protect that $100,000 portfolio, I would need roughly 4 contracts. Technically, 100,000 divided by 28.5 comes to 3.5 roughly. So I rounded it up, you'd buy 4 contracts. Ultimately, you'll determine how much insurance you feel comfortable with. So let me walk through an example here. Remember, back in October, we got a confirmed down call on the SPY on October the 4th of 2018. Now, we never know when those confirmed calls are going to be as dramatic as this one was. This was a very violent sell-off over the last 3 months of 2018. So on 10/4, we close with a confirmed down. Our scenario says that on October the 5th, 2018, we're going to go look at that SPY put because the overall market has just confirmed a downtrend. At that time, SPY is trading right in the neighborhood of 287.82. So we buy 4 SPY December 285 put options, and it cost us $3.53 per share, or for 4 contracts, $1,412. That's a debit to pay off our portfolio insurance policy. Well, we know what happened to the market. How well did our insurance policy perform overall? Let's take a look. From our options analyzer, I have what's called the trade simulation graph. So again, we went out, if we look at the bottom line here, in October we went out and bought a December put option as an insurance policy because we got a confirmed down call. Specifically, we bought the December 285 put when the stock was trading right around 287, almost 288 per share, and we bought the 285 strike, and it expired on 12/22. That was the expiration date. We bought 4 contracts based on our method. We paid $3.53 per share. So what happened in our trade simulation graph, when we take it out to expiration, the overall trade would have gained $16,308. Now let me be clear. I'm not saying that you would have bought it here and held it all the way to the expiration and then that's what you should have captured. My goal here is to convey the importance of being proactive and buying insurance so that you can mitigate those drawdowns. So at any time during the life of this trade, it could have been closed for the profit, but quite frankly, the technique we like to use, because it is an insurance policy and not a trade, is to basically hold these right through to expiration. And if I end up not needing the insurance, then great. Just like in a life insurance policy or a car insurance or homeowner's insurance, right? What we always say about insurance is that it's better to have it and not need it than to need it and not have it. I use this illustration, number one, because it was recent, and number two, because it shows a very good illustration of the power of having an insurance policy. So had you held on to this insurance policy, in this case, you would have offset any kind of loss you had in your portfolio. So that's our third key principle, preserving your retirement nest egg. And that segues into the quote I like to use when we discuss building and managing our retirement portfolio from Mr. Mark Twain, when he said, "Don't just sit there and worry, be proactive, do something, anything about what's worrying you." And that's the perspective we want to take when we're managing our retirement portfolio. And that describes what we deem to be the ultimate retirement solution, and that is to just keep making more money. So thanks for taking the time to watch this presentation. On Monday at 2 p.m. Eastern Time, we will have a Q&A session that I'll be hosting. We'll talk more about these techniques. We've built an entire course around these techniques called the Ultimate Retirement Solutions course. We also have a retirement coaching group that meets every Tuesday. Join us on Monday. We'll talk more about that and other ways that you can build and manage your retirement portfolio. Thanks, and we look forward to seeing you there.
Thank you for taking the time to watch this video. Now, if you're new to the software or would like refresher information about the software, click on this Getting Started video right here. Thanks to all of your input, here's a YouTube video that we think would be perfect for you. Click right here. If nothing else, folks, just hit the subscribe button right here.